Hey guys, we are back. Quick question. Can anybody let me know if it's on YouTube? Can you check it out, see if it's on YouTube? Because on my end, still does not show as being live, and I'm sorry, that's the delay that I'm having. On the streaming server, it says it's on, and there was somebody watching. Then here, I don't see it on this computer. Can you guys confirm for me, please? Anybody? No? Checking. It's live? Okay, Nina, thank you. I appreciate it. All right, just wanted to make sure. So we are live. YouTube did an update today, and so did my streaming software. And I still haven't been able to get them to work properly. I always have to go extra steps to get them to work properly. All right, cool. All right, Muslima, no problem. I see you have a question on closing costs. Yeah, you can ask later or whenever you can. It's fine during this class. I have a question. If Dennis, if you're watching on YouTube, you're watching with Muslima. If you guys have any questions, also drop them in the chat. And Dennis, she says that you're watching for her. So I cannot ask you to blink twice if you're in trouble. I cannot ask that if she's forcing you. But I can ask you again. If you have any questions, feel free to reach out. Okay. On. Okay. All right. Cool, guys. So here's the thing. We're gonna go over computing prorations. So now there's gonna be some math involved. It's really basic because I'm not gonna be. There's a chapter just for math. Okay. So everything we're gonna go over here is just basic stuff. I'm gonna move right through so you understand how it works. That's it, right? As far as the actual calculations, some of them I'm gonna address, some of them I'm gonna skip. So I'm just letting you know up front. Now, computing prorations. There's two different ways to compute prorations. For accounting purposes or financial purposes, usually this is the method. So for accounting purposes, the 365-day method is usually based on the calendar basis, right? So for accounting purposes, most calculations are based on every month being equal, meaning having 30 days. So it's the 360-day versus 365. As you know, some months have 31 days, some months have 30, and some months have 28 or 29. So they vary. For accounting purposes, they said, hey, there's 12 months in the year, so let's keep things standard, 30 across the board. All right? The difference between them is going to be minimal. So, oh, by the way, the questions will always say hey, using the 360-day method, right? They'll tell you that. Using the 360-day method, how do you calculate this or how do you calculate that? Or using the 365-day method, how do you calculate this or how do you calculate that? So they will give you that in the state exam question, okay? What is the 12-month, 30-day, or 360-day method? What we have to do first is identify the total amount to be prorated, right? So let's say it's $12,000, right? $12,000. There's that's the taxes. There's 12 months, so it's easy. It's $1,000 a month, right? But if we're talking about the monthly, if you want to know the daily average, now we divide that by 30, right? So by 12 is for you to get the monthly. So 12, obviously, for you to get the average monthly. By 30 is for you to get the average daily. Okay. Now, why is this needed? If you guys remember the example we had before the break, right? This is 1 month right here. We closed on August 7th, right? So I need to get to the monthly or to the daily rate, depending on what the question is asking. In this case, I need to get a daily rate, so I figure out what's the buyer's share or what's the seller's share. You guys get it? Okay, so they'll ask you to use the 360 or the 365. Once we get to the daily rate, we multiply the monthly amount times the seller's number of months of ownership in the year of the sale up to the month of closing. So for the month of closing, you multiply the seller's number of days in ownership times the daily amount, and then you add the results at the end. So here you go. Here's an example. Let's say it's taxes. Okay, this is a potential question. That's why I'm telling you, I'm just going to go right through because it comes with a full example. This is a potential question. It says, prorating an annual item. See, the taxes are annual. They're not monthly. They're not daily. Taxes are annual, right? But we closed a single family house on March 2nd. Now, March is the third month of the year, correct? And we close on March 2nd. So there's 2 months into that third month of the year. But did we complete the whole month? No. So technically we have January, February, and 2 days of March. So there's 2 30-day months and then 2 days, right? So 60 days plus 2, so 62 days. How do we figure this out? Simple. First of all, the amount of taxes was 1,730. That's the first thing. The seller owns the house through the day of the closing, and they will give you this as well. That means that the buyer is only responsible from the next day on, from the 3rd on. Okay? So they will tell you, this is an actual question, right? And what are the sellers and buyers prorated shares of the item? So until March 2nd, right there, until March 2nd, the seller owns the house, so therefore it's the seller's responsibility until that day. Total amount due for taxes, 1,730. We're going to figure out what the monthly amount is. So we divide by 12. That was the first step. Then we get to the monthly taxes, 144.17. That's the monthly taxes. Because there's 2 days there, we need to figure out what the daily rate is, so we adjust to that particular 2 days. So what are we going to do? We're going to divide by 30. And the daily is $4.81. That's the daily charge for these taxes. Okay? Now, they were there for January, February. 2 months of 30 days each, right? So, this right here is the 2 months obligation, $288.34. But they were there for 2 days. The daily rate is $4.81 times the 2 days. So those 2 days are worth $9.62. What is the seller's share? What does the seller has to pay in connection to this transaction? Well, we're going to add them. We're going to add the 2 months, which is $288.34. And then we're going to add the 2 days, which is $9.62. So the seller's share is $297.96. If they were asking you, what is the buyer's share? Well, if the yearly taxes are $1,730, and we deduct the seller's share, then the buyer is responsible for $1,432. Right? That's the remaining of the year. From March 3rd and on, the buyer is responsible for that, not the seller. Guys, good so far? Great. Perfect. So how would this look in the closing statement? How would this look? See, what it says here, let me go back up. What it says here, the identifying thing in the question is that it's paid in arrears. Can you guys remind me, what does it mean to be paid in arrears? Can you guys remind me that in the chat real quick? Because this is key. For you to understand who pays what, this is key. What does it mean to be in arrears? What does it mean to be paid in arrears? Okay, Amy says in advance. Nina says unpaid. Who else? Felix says pretty much unpaid. Like, simple to say unpaid. He goes like pretty much unpaid. What else? No wrong answers today, okay? Don't worry about it. Just throw me something. Okay, Elda says unpaid. Okay. Okay, who else? Nidia, give me sign language. What is it? Since you can't type, what is it? Let me know. Put her on the draw board. There you go. Hey, whatever works. Brittany, give me an answer. Katrina, Benjamin, Arlene, give me answers right here in the Zoom chat. Whoever's watching on YouTube, there's 3 people watching on YouTube. Let me know. Very good, Nidia. Very good. Brittany says unpaid. Anybody else? Benjamin says unpaid. I'll give you 10 points for the answer. Go ahead. 10 points. I'm offering points today. Yes. Olga, your answer already? Nope. Olga, what does it mean? In arrears. In arrears. The question is paid in arrears. What does that mean? Unpaid. All right, cool. So, very simple. Arrears means it's building up. Means it was not paid yet, so it's unpaid. Okay? If it was paid in advance, it was prepaid. Okay, so in arrears is unpaid. So now, why did I ask you this? Why is it so important? If it's an unpaid item, so paid in arrears, right? That means that the seller did not pay yet, right? And the buyer is responsible for paying it. Correct? Good so far? Great. So who do we debit and who do we credit? Let me know in the chat. That's the next one. Who gets the debit and who gets the credit? If it's unpaid bill, if it's an unpaid bill at closing, right? Who gets the debit and who gets the credit? That's the second question for this. Again, guys, no wrong answers. It's just really putting out there and seeing where you are and you being able to explain. Okay? So Felix says the buyer gets the debit and the seller gets the credit. Okay. Again, just throw whatever answers. There's no wrong answers. If you're watching on YouTube, please participate. Seller gets the credit, says Arlene. Okay. Olga, debit to the seller, credit to the buyer. Benjamin, debit to the seller, credit to the buyer. Nina, debit to the seller, credit to the buyer. Who else? Who's missing? Elda says seller to the credit and debit to the buyer. Okay. Nidia, here's what I'm gonna do with you. What my daughter, my 6-year-old daughter is doing, she has a whiteboard. Okay, and that's what the school requires, a whiteboard. So instead of sometimes turning on the mic if people have, the children have difficulty, what they do is they write on the whiteboard and they present that to the teacher. So Nidia, if you can't type, get a whiteboard, present it to me. I want your answers too, okay? And I'll give you I'll give you a star for every correct answer. All right, guys, so here's what we got. If it's unpaid, means the seller did not pay. So who's responsible for paying it? The buyer. So therefore, the credit to buyer, because the seller did not pay the bill, the seller has to pay his or her portion to the buyer. So it's a debit to seller, who will credit the buyer. So it's taken from the seller because it's unpaid and given as a credit to the buyer because the buyer will have to pay. All right? So how much is the seller's share? $297. What must the seller do? Right here. The seller will be charged for that $297, and that $297 will be entered as a, again, as a debit to the seller and as a credit to the buyer. Because again, who was responsible for paying the bill up to that day? The seller was. So we take money from the seller and we give that money to the buyer. All right? If it said prepaid, that means that the seller had already paid for it, right? Then instead of $297, this number would have been $1,432, taken from the buyer, given to the seller because they prepaid and did not use. You guys got it? Thumbs up? Cool. Now here's the thing, because it's a credit to the seller, because it's a debit to the seller and a credit to the buyer, here's what we're going to see. We're going to see minus $297.96 and then plus $297.96. It's the same amount. So minus to the seller plus to the buyer. But it's the exact same amount on both ends. What's taken from one, given to the other. So imagine this, guys, just to make it clearer. Imagine this. You guys are going to go to the supermarket, right? And you have a card. You get to the supermarket and you have a bill to pay. $20. You bought something, right? $20. You swipe the card, correct? So you are the buyer and you're paying for something. As an example, you're paying for something. In your side, on your bank account, in your side, it's going to be minus, because you swipe the card, it's going to be minus 20, right? At the supermarket, on their side, because they're the seller, what is it going to be for them? It's going to be plus 20. So the amount is always the same, guys. The amount is always the same. It's just that it's taken from one party, given to the other, but the amount is always the same. The key is knowing who gets the credit, who gets the debit. Okay? That is key. If you guys go and return that item, that $20 item, you go return it, right? As an example, let's say we're going to return it. What's going to happen? It's going to be a minus on the supermarket side, and it's going to be a plus on your side. Same concept. $20 does not change. In this case, $297. You just have to really remember who gets the debit who gets the credit. That is key. So let's look at rent as an example. Rent is a monthly item because rent is paid every single month. So it's a monthly item. If we use the 12-month, 30-day method instead of the 365, right? Then we're going to assume that the month of March, has 30 days. That's what it says here. So this example is the house in the previous example that we said has been rented during the listing and selling period at a rate of $1,800 a month. The rent for the month of March was paid to the seller. Keywords in the questions, right? Keywords in the question. It was paid to the seller. So the seller received that money already, right? On March 1st. So the question is, what is the buyer's prorated share of this rent? The day of the closing, March 2nd, belongs to the seller. So the buyer is from the 3rd and on. Remember that, like I said before, from the 3rd and on, right? So how much did the seller receive? 1,800. So we're going to divide this by 30 days, right? Because we already know it's a monthly thing, right? We're going to by 30 days, and we know $60 is the daily amount. Okay? The seller had the property for 2 days of that month, right? So $60 times 2 days, $120 is the seller's share. How much is the buyer's share? Well, 1,800 minus the 2 days. So the buyer's share, 1,680. Now, the question I asked Elda before was, should the seller keep the whole 1,800 even though they were there for 2 days only? The answer is no. So what must we do? As a seller, I need to give to the buyer that difference. I already collected it. I already have it, right? So 2 days, 120 are mine. But the remaining days from the 3rd and on, buyer, they're yours. So I need to credit the 160 to the buyer. Credit to the buyer. And again, debited from the seller. So again, seller. This is how we will show in the closing statement. Seller, it's minus 1,680. And then buyer is plus 1,680. Again, same amount. Guys, the point still is same amount and who gets debited, so minus, and who gets credited. What if the question says, let's go back to the question. What if the question says the seller has not been paid yet? If it said not been paid, so then the seller never received it. So the seller is owed 2 days, right? So then it would have been minus 120 to the buyer and then plus 120 to the seller. Are you guys understanding this? All right, so, no? Okay, Elda, it's a question I asked you before. If I did not receive the rent yet, I'm the seller. I'm sorry, you were the seller, I was the buyer in the example. You did not receive the rent yet. We close on the 2nd, right? So from the 3rd on, it's my responsibility for the property, right? But then we get to the 15th of the month, and the tenant finally pays. Pays who? Me, right? I'm the buyer. Paid me, the buyer. I'm the new owner. So the tenant paid me. Am I entitled to keep the full month's rent? No, because Elda, you were the owner for 2 days. We closed on March 2nd. So I must return to you 2 days worth of rent. Now, when does this happen? At closing. Okay? Elda says, wait. I'm waiting. I'm waiting. You gave me the sign like don't move. Benjamin is arguing with his buddy. Don't argue with me, okay, Benjamin? It's not my fault. Nina disappeared, so I think Nina's typing a question, maybe. I understand that's the book. Oh, you have different amounts. Is that what it is? Oh, okay. But the concept is the same. Okay, cool. You understood. Okay, great. Nina, let me know if you're typing a question or if you just disappeared. There you go. There is a question. It's what I said. So what you just wrote is what I was saying. The buyer can receive after the closing, right? But at closing, I still have to, because technically it is expected that I receive the rent later, right? It is expected that I will receive it later. So at closing, regardless, I'm going to give you credit for that difference. So let's say if it's unpaid rent that I'll collect later, I still have to give you at closing 120. So this would be reversed. It would be seller plus 120, buyer minus 120. Because I will receive the 1680 later on. Does that make sense? So everything, guys, it's what Felix was asking right before the break. Everything must be adjusted at the time of closing. That's key. We do not move forward without having that adjustment. What might happen is we put some monies in escrow just in case, right? So that's for final adjustments that might happen later on. We put money in escrow, like, hey, here's $2,000 set aside. If we collect, great. If we don't collect, hey, it sucks. But it's already set aside. Everything is adjusted to the T, to the day of closing, okay? So that was the 360, 30 days method. The 365-day method uses the actual number of days. So this is the way that, this is the way that everybody should calculate, because there's 365 in the year. Everybody knows that. So, but for financial purposes, usually they use the other method. So the concept is exactly the same. The only difference is we're not dividing by 30. We're dividing the total amount by 365 to get to the daily amount. If it's a monthly proration, we divide the total amount by the actual number of days. So again, if it's a 31-day month, we divide by 31. So again, guys, this should be very similar. You guys already know where we are. In the previous example, we closed, so sorry, Elda, if you have different numbers, but, and Nidia, whoever has the book, but the concept is the same. So we closed, remember the bill, the yearly bill was 1,730 in this example here, right? We closed on March 2nd. Now, again, in arrears, that means unpaid. So the concept is the same. What we have to do now, using the 365 method, is divide the yearly bill, divide by 365, and we get to daily rate. Now, I know it says daily right here, but that 475 is the daily rate. Now, so in this case, we have the, because of the actual number of days, right? There's 61 days, because February, how many days does February have? 28, right? So now it's different. It's not 30 and 30, right? You could have 29. It's not 30 and 30, right? It's now, in this case, 31 and 28. That brings us, and plus the 2 days in March, brings us to a total of 61. So 31 plus 28 plus those 2 days. So again, January, because we're using the actual number of days. So January, right, plus February, plus the 2 days from March that we use. What is the total? 61 days, right? So 61, guys, 61 times the daily rate. The amount is 39.14. All right, Juan, I received a message from Juan. It says E. If you have more than E to say, go ahead, ask the question. But it's good that you're there listening, Juan, and participating. I appreciate you. All right, so here we go. We figure out the total amount of days. Simple. We figure out the daily rate. Simple. We figure out how much the seller has. It's $289.14. How much does the buyer have in their share? Well, again, it's the yearly tax minus the seller's share. We have the buyer's share. Did you guys notice a little difference? A little difference between the previous method and this one? The bill is the same, right? The bill is the same. But in the previous one, it was $297, something like that, right? So there's $8 more here. And in this one was, how much was it? Let's go back. There you go. $14.32. So again, just wanted to confirm, it's the $8 difference, right? The difference between the, so the difference between the 365 method and the 360 method, right? Whatever they ask you in the exam, the difference is minimal. It was $8 off, right? So it was plus $8 here and minus $8 here. That was the difference. Concept is the same, 284. We always go back to this because it's in arrears, so unpaid. Sellers minus 280,914, and then the buyer plus 289.14. Okay, so concept exactly the same. Debit to one, credit to the other, same amount on both sides. The only difference was based on the method that you use or they ask you to use. The only difference is the amounts might change slightly. That's all. Okay. You have any questions before I proceed? Questions before I proceed? Thumbs up if you're good. All right, cool. So moving forward. Taxes due at closing. State taxes on the deed and state taxes on the mortgage. So here's the thing. Most states impose a transfer tax. It's called a realty. Transfer fee. Okay. So when you record the transfer occurred, you are charged a fee by your state. Every state has a different method of calculating, so it's specific. The tax rates are specific to each state. Here he gives you an example of what it would be. So again, every state has their own tables of rates. So I don't focus too much on this. State exam doesn't ask you about this because it's not it's specific to each state. But in this example, as you can see, so the tax is a percentage of the taxable consideration as a dollar rate per 100. And if you sold for 350, 120, you divide by 100, and 3,501 is the number that you need to use for the rate. If the rate is 55 cents, then this is how much you have to pay in realty transfer fee. again, I wouldn't focus too much on this. I haven't seen a math question in the state exam. I haven't seen any of these questions pop up because, again, it's state specific. So from state to state, it varies. But if the question does pop up, again, the dollar rate is per 100. They'll tell you that. All you have to do is divide by 100 and then times whatever the rate is. The tax rate here is $5, 55 cents per 100. I'm going to give you another trick later on. Every time you see per 100, when we get to math, I'm going to give you a trick on the per 100 part. So right now, we're going to go to closing cost itemization and case illustration. So this right here, so selling terms and closing costs. I'm going to give you a heads up. There's a lot of text here. There's no question in the state exam that it's this long. If you have long questions, skip them, leave them to the end. That's my number one rule when taking the test. So if it's a very long question, skip it, or mark it, skip it, and then at the end, you can answer. So you get rid of the quick questions first, and then you address the long questions. And even the short questions. If you're taking too long trying to figure it out, don't dwell on it. Click mark or skip, come back to it. Simple. All right? So the easy ones that you're 100% sure, answer. If you're not sure whether it's long or short, skip it. Okay? Math questions, always leave it to the end. If you use this method, it's almost guaranteed, in my opinion and experience, it is almost guaranteed that in the first hour of the exam, you get rid of 80% of the exam by doing this. That means now you have 3 hours to handle 20% of the exam. So you're more relaxed, like, oh, I got this. Does that make sense? Right? So what's happening here, so I don't want you guys scared, that's why I gave you this information right now. What's happening here is just describing a whole transaction, and these are the closing terms. And then it's going to show us how we would play in the documents. So this is a whole transaction beginning to end. See, Lawrence and Sandy, they accepted an offer for their house located at 98 Elm Street, right? The buyer, Bill and Dillis Waite, they offered $450 and put earnest money or good faith deposit of $70,000 into the property. The remaining $380,000 of the purchase price come from a conventional loan. Now, the loan is for 30 years at 5.5 interest with a monthly principal plus interest payment of $2,158. The lender's charging 1.5 points and 1% origination fee. The closing is set to happen at the title company at 4 p.m. on May 10th. All right? So they even tell you non-leap year. So you know it's 365, right? All right, so there's more to this. The binders agreed, so the seller agreed to pay a broker's commission of 6%, and the unpaid mortgage on their loan, so the balance of the loan is $184, with a monthly interest payment of $613. The annual interest rate is 4%. Previous year's taxes, $2,700. I'm sorry, my hand disappeared there. I know. $2,572. There are to be assumed, whatever. So this is the whole story of this transaction. This will not be a question in the real estate exam. What they might do is take bits and pieces of all this to create 2 or 3 different questions, right? But you'll never have a question of, hey, like the whole life story of this transaction and now figure it out. No. But as a realtor, this is the whole life story of your transaction and how we're going to put it in the closing documents. So do you have to do it? No. Do you have to understand it? Yes. Okay. So what are the selling terms? Let me bring it here. What are the selling terms? Well, the sales price is a selling term. $450 is the purchase price. Right? How much did the buyer put as a deposit or down payment? $70,000. What is the loan amount for the buyer? $380. Simple concept. because this goes in the offers, by the way. When we prepare contracts, we're closing at $750. Between down payment and deposit, there's $70,000. The rest is going to be payable with the loan of $380. Okay. Now, the seller paid costs. The seller pays usually, okay, these are the traditional seller paid costs. The seller pays usually 6%, let's say, that's the commission negotiated, 6% of sales price at closing. Real estate taxes, $2,572 to be prorated. Title insurance, depending on the state that you're at, the seller pays for it. So in this case, $900. Seller's attorney, $1,500. Record release deed, so you have to pay $25 to get your deed out of there. Survey was $550. Transfer stamps or realty transfer fees and so on, they're $162 plus $162. And the seller payoff of the loan, remember, their balance was $184. That's the principal balance. And remember that they had $631 to pay in or whatever to pay in interest for that month. But because we closed on the 10th, we have to pay only 10 days of that. I'm sorry, 613. We have to pay 10 days of those 613. Guys, do not stress with the math right now. We're just showing more or less what seller pays, what buyer pays. That's all. Okay. What does the buyer pay? They pay the $450, the purchase price. That's logical, right? If I'm buying for $450, I have to pay $450. How do we pay the $450? Well, $70,000 was already deposited by the buyer, right? Appraisal fee was already paid by the buyer because during the process, appraisal fees are paid up front. Credit reports, the buyer already paid $50. Closing fee, $350. Recording fees, $55, and so on. See there? Boom, boom, boom. Everything is given in detail. At closing, every single number must be accounted for. Stuff that you already prepaid, stuff that you have unpaid, stuff that you're paying that day. Everything to the T. That's what I'm showing you guys. Okay? Nidia, I'm sorry. You're sideways, Nidia. It's hurting me. Sorry. Oh, okay, cool. Oh, you're back. Whew. Remember, I have a back problem. I can't be like doing the twister or anything like that. All right. Again, the buyer's loan was $380 for 30 years at 5.5 with 1.5 points of loan amount. Origination fee is 1%. Insurance is $2,400 a year. Taxes $2,572. They're asking for 8 months of taxes and 4 months of insurance up front. So like put money aside, so escrow in pound, right? And prepaid interest from the day of closing, after closing at the end of the month. So again, yes, all these are taken out of the 450, Felix. Absolutely. So these are not additional expenses. These are out of the 450. I'm sorry. Some of the stuff are the 450, not all of them. I'm going to show it to you right now. So how do we figure out commission? So commission is the gross amount times the commission. So the commission in this transaction, $27,000. Guys, this is the gross commission. This is the total commission. Then it has to be split with brokers, between brokers, and the brokers split with their agents. Real estate taxes. I already showed you guys how to calculate these, so we're going to skip for now. Unpaid. Fees. We talked about this as well. Escrow talked about this. Prepaid interest talked about this. So I'm going to show you right here, when we get to the closing disclosure form, I'm going to show you all these numbers. Now, TRID right here, this is TRID. TRID is the TILA RESPA Integrated Disclosure Rules. We repeated this a million times. Sorry guys, just 1 second. All right, so guys, we already mentioned all this stuff. Like TILA is the TILA RESPA Integrated Disclosures TRID as of October 3rd, 2015. The first step is at time of application. At the time of application, we got to give you the home loan toolkit. Step number 2, no later than the 3rd business day, you must be provided with the LE. You guys remember this from the first half, right? Then I got to give you a CD at least 3 business days before the actual closing, okay? So these are the steps that we keep on repeating. As I mentioned earlier, TRID does not apply to, so the loan estimate and closing disclosures are not provided for HELOCs, for reverse mortgages, mobile homes, or cash transactions, or anything like that. They do not apply for that. For those, we still use HUD1, good faith estimate, and TILA disclosures, so all those forms. The combined forms apply to purchases of residential properties, 1 to 4. Could be a first and second mortgage, if you guys remember, and mainly for federally related transactions. As far as the closing disclosure, the CD, what are you going to find in the CD? In the CD, you're going to find 5 pages. And these 5 pages include different things, obviously. But the first page has 4 sections. In the first page, you're going to find general information about the loan terms, projected payments, and the costs at closing. So that's page 1, and I'm going to show you in a second. Okay? On page 2, it's going to be detailed what those costs are. Again, I'm going to show you in a second, so don't stress too much about this right now. On page 3, it calculates how much cash you need to close and summarizing the transactions between the borrower and the seller. Page 4, additional loan disclosures, whether you can assume the loan or not, if there's a early prepayment, if there's late payment fees, if there's a negative amortization, so just additional info. And page 5 just gives you more calculations, disclosures, and contact. So loan calculations, other types of disclosures, contact of the people that were involved in the transaction, and then confirmation of receipt of this. I'm going to show you that both the buyer and the seller must sign that they're okay with it. So in this case, we're talking about the borrower. So in this CD I'm going to show you, it shows what the borrower must agree to and sign. So here's the CD. Okay, make sure, if you have the book, make sure you go to the CD page. Not sure what page will be on first edition. We're on page 21 here. I'm sorry, not page 1. We're on page 339. Yours might be possibly 337 or something like that. But get to the CD. It says sample H25 closing disclosure. Make sure we're on the same page. Who has raise your hand if you have the physical book. I see Nidia and Zelda, right? And Amy. Okay. Guys, make sure, are you on the page? Give me a thumbs up if you're on the page. Yep, okay, great. So I just want to make sure you follow me on this, because this document is not only for state exam, I mean, it won't be on the state exam. You have to understand it for real life purposes, okay? Because every single transaction, or if you do residential transactions, every single one will have this. And it's very important because this is what you need to explain to your client. In this document, here's what you're going to find. The date that it was issued, the projected closing date, the disbursement date, so when the funds are going to be dispersed. Where are we going to close? Who's the closing agent? Right? The title company. Right? What is the property? What is the sales price? So with the CD, we're going to figure out if everything is correct. Who's the borrower? Who's the seller? Who's the lender? This is a 30-year loan. So make sure, Mr. Borrower, that this is correct. You applied for a 30-year loan. Yes, great. This is for a purchase. It's not a refinance. Great. This is a fixed rate, not an adjustable or variable rate. Great. This is a conventional loan, not an FHA, not a VA, or another type of loan. Great. See, we're checking all the boxes, making sure everything is okay. And you're probably thinking, well, isn't that the loan officer's job? Yeah, kind of, right? But remember, we're the maestro, we're the coach, we're the one that makes sure that everybody is in the play, right? And we present that to the seller and say, hey, is this correct? Like, I activated everybody to play for you, but is this correct? Let's go over the numbers. After down payment, so purchase price is $180. After down payment is the loan amount, $162. So, Mr. Buyer, right? Mr. Buyer, here's the thing. Over the next 30 years, you're going to have $162 as a principal balance at an interest rate of 3.875. Now, guys, remember this number. Remember this number. Okay? We're going to address it later. Monthly principal and interest, $761.78. So you know that your financing payment is $761. You know that. Can these amounts increase? Look, can these amounts increase? No, no, and no. Is there a prepayment penalty? Depending on the type of loan, so if it's FHA, there cannot be any prepayment penalty. And depending on the state that you're in, it will say no. In this scenario, it says yes, the prepayment penalty is as high as $3,420 if you pay off in the first 2 years. After 2 years, no penalty. No worry. Right? Does it have a balloon payment? No. All right. Next, what is going to be your estimated total monthly payment? Mr. Buyer, is this the amount you agreed to? $1,000 a month? Is that it? $1,050 a month? Is that it? If it is, great. If not, well, let's figure it out. $760 is principal and interest, but your taxes and insurance are $206, and you have PMI or MIP, depending. So this is PMI or MIP. You guys already know the difference between these, right? So there's an extra $82. Oh, that's where okay, because I thought it was 900 and something. That's why it's 1,050, because it has PMI. Like, yeah, absolutely. Estimated taxes are $350 a month, so on. Closing costs. Look at this, guys. At the time of application, within 3 business days, you will receive an LE. This page is the same as the LE. It's the estimate of the closing. Now, the LE might say $8,000. Right here it says closing costs is $9,000. The LE might say $12,000 cash to close. Here it says $14,000, or vice versa. It could be $16,000 and you wind up just paying $14,000. But it's telling you, tell your clients they need at the time of closing a check for $14,147.26. They need this money to close. That's the balance of the down payment plus closing costs. Okay? So we already gave $1,000 or $5,000 as a good faith deposit, right? But the down payment is $15,000. Well, if I gave $5,000 minus I'm sorry, if it's $15,000 minus the $5,000, then $10,000 is how much I need as a down payment, right? That's the balance of the down payment. The closing costs are X amount of dollars. So balance of down payment plus closing costs, that's the money you need at closing. In this scenario, $14,000 is how much you need to bring at closing. So can you tell me, oh, I didn't know? No, it was right there. You just didn't read. So guys, your clients don't read, so make sure you read for them. They just sign papers. I don't know if you ever noticed this, but you guys do this all the time. I do this all the time, right? Elda's like, yep, guilty. Guilty as charged. Yep, me. Right? You guys just go there. Oh, papers, sign here. And nobody reads, right? And then when something is wrong, you go look for that paper and like, oh, yeah, it was right there. It's always like, tell me it's not. Tell me it's not true. Right? Always. Like the gym membership. This happened to me. Gym membership. Okay, Amy's smiling already, so she got it too. Gym memberships. Tell me you did not sign for a gym membership, right? And the only day you went to the gym was to sign up. But, guilty. So you sign for a gym membership. And, okay, fine. I want to cancel. Nope, can't cancel. This is a 1-year contract. So then, 1 year goes by and you think, okay, fine. I paid for the whole year. I lost this money. The 45 or whatever it is. $50 a month, whatever. So I lost this money. Come January, and there's another charge for the membership. And you're like, oh, this is $50 for 1 year. Like paying $50 a month for 1 year. Yeah, you did not read the clause that says if you don't cancel before the year, it's going to renew. You guys understand? So these are the fine print. Look, it's there. Nidhi is laughing. Like, you guys know what I'm talking about, right? It's right there. So if your clients don't read, it's your job to read. Page number 2. Look. Points that the buyer has to pay. Right there, 405. Application fee, underwriting fee. It's right there. Appraisal fee, credit report fee, flood determination fee, flood monitoring fee, tax monitoring fee, tax status research fee, pest inspection, survey, bow. All these fees are detailed. Guys, this is what you're paying for. All this is detailed. This is on the buyer side. On this other side is the seller. Okay? So we're going to find this as we go. So right here, recording fees. Recording fees, there's recording on the buyer side and there's recording on the seller side. Homeowner's insurance, mortgage insurance, prepaid interest, property taxes, homeowner's insurance, whatever. Everything is here. Everything. The only thing that matters, you guys, the only thing that really matters in this whole, all these pages that you guys need to verify, right? Nidhi already saw what it is. The only thing that matters, and that's why you guys really need to know this, right? And this is because of Nina. Because of Nina, right in the beginning, right? She said that the only thing that matters at closing is, she agreed with my statement. The only thing that matters at closing is, there you go, Elda, right there, money. So, Nina, if you want to know about your money, it's right here, section H. Section H of page 2. And it's line 5 and line 6. Let's figure out if this is correct. So there's 2 brokerages involved. You work for Alpha Real Estate Broker. Your broker will receive a whopping $5,700. Is that amount correct? If yes, move forward. If no, wait a minute. Neither the buyer nor the seller are going to close until my amount is corrected. Let's fix this. I need to get paid, right? Because Nina, that's the only thing that matters, right? All right. I'm just kidding. But on a serious note, definitely verify your commission because it is important. If something is off, then it's off. But again, everything else is important right here. Total costs and so on. On page 3, how did we figure out how much cash the buyer needs at closing? Remember I said there's loan estimate and there's the final, the CD, right? Look. In this page, they tell you the differences between the LE and the CD. From the, hey, what we estimated and what we now need to pay. It was $8,054, but you have to come up with $9,712. Did this change? Yes. $0 for closing costs paid before closing. But then the final is they give you a credit. So it's minus in this sense, but it's a credit to you, of $29 because you already paid these closing costs before closing. So somewhere in one line, we'll go over that later. Next, down payment, funds. You needed $18,000. You're paying $18,000. Did this change? No. Deposit. You put $10,000 deposit, right? Final 10. Did this change? No. The same, right? Seller's credit and adjustments for other credits. Well, initially we did not know, so there's no credit from the seller. But at closing, they gave you credits. So did this change? Yes. The seller gave you $2,500 in credit. So these are the adjustment, guys. Initially, when we started, you showed your client that they needed $16,000 to close, right? That's how much they needed for closing costs. Well, right now, they only need $14,000. So this is the amount needed at closing. This is the final amount, all right? Bottom line here, again, is we're showing you how a closing happens. Do we need to know how to calculate all these amounts? No. Do we need to know who pays what? Yes. Okay? Because they will ask you these questions. On this side, we have the borrowers. On this side, we have the seller. Due from the borrower. The borrower needs to come up with $189,762. What is this? It's the purchase price plus some closing costs. So, Felix, some stuff comes out of the 180 or whatever, the 450 that you asked before, and I'm going to show you that on the other side. But the buyer has an additional closing cost to come up with. On the seller side, they will receive, so due to the seller, so it's a credit to the seller, they will receive $180,000 plus $80. It's the sale of the property, 180, right? And HOA dues. So they prepaid HOA, so they get $80 in addition. And look, taken from the buyer, given to the seller, same amount. All right, so we're just verifying everything we've been going through. Next, on the buyer side, items already paid by the buyer, like the deposit, $10,000. Okay, the loan amount, $162. Wasn't the loan already credited to the account? So yeah, right there, boom. So how much did the plus seller credits? $2,500. So how much is this total? $175. 16 with, oh, there's other credits. There's a rebate from the title company. They amount to $175,615. So on, and so on. So total due from the borrower. How much did the borrower need to come up with? $189,762, right? But because there's the loan amount and adjustments, the only thing the buyer has to come up with at closing is the $14,000. That's what it is. On this side, seller. I'm sorry, I just got distracted with a message that came through saying that somebody's going to cook for us. So, I mean, all right, class is over. All right, anyway, so $180,000 plus 80 is how much the seller is due, but the seller has to pay what? They have to pay $100,000, which is the balance on the loan, plus closing costs are due to the seller. So $115,000, that's how much they have to pay. Oh, and the credit that they gave the buyer, right? The $2,500. So the seller was to receive $180 plus $80, right? But they have to pay the balance on the mortgage and other fees. So how much does the seller net? How much do they take home? $64,414.96 to the T. There's not one more cent or one less cent. This is exactly what the seller is going to receive. Mr. Seller, are you okay with this? Is this the amount we expected? Great. Move forward. All right. So I know a lot of schools don't spend time in this, but I think it's critical that you understand the necessity of you going through this document. Credits and debits. Okay. Page number 4, we're almost done. Page number 4 of this document says if the loan could be assumed or not, if there's a demand feature, like you have to prepay or pay something early, the late payment features, the escrow account features, negative amortization if it exists or not. You guys should know all these terms by now. If they accept partial payments or not. Everything is on page 4. And this is the key page for the buyer. Okay, besides all those numbers, now it's the summary of how much you're going to pay. Remember, we borrowed $162,000, correct? Is that how much we borrowed? Great. How much are we going to pay? $285. Okay, so over 30 years, how much does the $162,000 cost me over 30 years? It cost me $285,000. How do we figure that out? Well, the interest charged was $118. So Mr. Buyer or Mrs. Buyer, if you carry the loan for 30 years for the full term, you got to pay $118,000 in interest. If you prepay, it will be less than this, but this is projected based on the whole term. Thumbs up? You guys with me so far? Great. So you borrowed $162, and on top of it, you paid $118, so that is the $285, right? The APR is 4.174%. Question. You guys remember the number I told you to remember about 3 pages ago? I didn't say go back. I'm asking if you remember. And they're going back. It said 3.875, right? As Elda's speaking and I'm reading your lips. That's what it is. Okay, 3.875. We're good. All right. Why are these numbers different? See, this document tells you what the pure interest or basic interest is, 3.875. But it must also disclose what is the true cost of borrowing the money, which is 4.174. This is the APR. You're not paying 3.875. You're paying 4.174. And this was given to you also in the beginning with the LE. So pure interest, there's two things. There's pure or basic interest, and then there's APR. This is the number that counts. Because another bank could have 3.875, but the APR be 4.025, as an example. Right? So this is costing you, the true cost is 4.174% in this scenario. Okay? Now, did anybody ever go to a restaurant? Let me know if you've been to a restaurant before. All right, cool. So if you've been to a restaurant, if you're happy, if you're satisfied, would you give a tip? Of course, right? If I'm happy, if I'm satisfied, here's a tip. Great. The banks are imposing the tip on you. Now, can you guys let me know in the chat real quick? Held this face. Can you guys let me know in the chat real quick, what would be the tip that you usually present at a restaurant? Like, how generous are you in the restaurant? I'm not going to judge you, though. Okay, so don't worry about it. How much would you give at the restaurant? I won't even show on the screen, so I don't, YouTubers do not know. Okay, it's just for me to know. How much would you give? Okay, cool. I got it. Nidia, I saw it. Okay, we're cool. Everybody shy? Like, let me know what the tip is. What would you tip? Come on. Nurika says $10. Your tip is 10. So if you spend $5, you can put $10 in tip? Is that what you're doing? Or is it a percentage? Amy says 10% for good service, 15% if they're attractive. Amy, I'll handle the tip. Don't worry about it, because 10%. Whew. But if they're attractive, 15. All right. That works. Anybody else? 10% for good service. So let me ask you something. If the service is bad but they're attractive, you do 15%? Amy? Like, service was horrible, but Felix, the tip depends on you're funny, Amy. Tip depends on how satisfied I am with the services, so it varies. Nina says whatever I feel is called for, perfect. And then Yurka says the $10 was for good service. All right, cool. So here's the thing. The bank you know how some restaurants, they already impose the tip, they already put it there? All right, so here, the lender also tells you how much the tip is. Not that bad, right? It's not that bad. I mean, Amy, look at me. They're very handsome. They're very attractive. The bank is very attractive, right? Guys, this $118,000 here, $118,000 represent 69% of this loan. That's what it is. All they're saying, it's not tip. This was just a joke. It's called the total interest percentage. So compared to the amount that you borrowed, how much did you pay in interest? You paid 69% of the amount borrowed in interest if you carry it for the whole term, okay? So don't get scared. You're not paying a tip, right? It's total interest percentage. All right. If the borrower is happy with it, the numbers are good, they need to sign, date, we move forward. The seller also receives something similar regarding their amounts, and they have to also sign and move forward. Once everybody's in agreement, we have the closing date, and we're good to go. Okay? Real quick, and we're done. Reporting requirements. What reporting? Tax reporting. All it says about reporting requirements is that somebody must report to the IRS that the transaction occurred. It could be the sales broker, buyer's broker, settlement agent, mortgage lender, or anyone designated by the IRS. So somebody must tell the world, the IRS, that a transaction for more than $10,000 has just occurred. That's all. Okay? So guys, boom. We are done. Any questions? There's a lot of stuff I know, but I think it was simple enough, very, very well detailed in this chapter. Actually, just so you guys know, I used to teach the Dearborn chapter, which is also chapter 21, closings, and I prefer this one as far as the detail, the way it's broken down. This particular chapter, there's a few that I prefer in the Dearborn and that I dislike on this one, but this particular chapter, I think it's clearer here than it is in the Dearborn version. So everything is good. Everything has its pros and cons. Like, that's what I feel. Felix is asking, so if it's less than $10,000, it doesn't have to be made known to the world, like you said. Yeah, so mainly transactions from, like, for instance, a rental is 1,500, 2,000, 3,000. Like, we have to let the IRS know, hey, there's a $2,000 transaction happening. No, but every time that you make some type of movement that's $10,000 or more, immediately must be reported to the IRS. What also happens, this is part of the Anti-Money Laundering Act, and what happens is transactions from $1,000 to $10,000. If I feel like it's suspicious transaction, I must report. It's called a SAR, so a suspicious activity report, a SAR report. If it's more than $10,000, then it has to be reported to the IRS. Now, with that being said, again, because of anti-money laundering and a bunch of other rules around the world and the countries that are involved in this reporting of transactions, is a lot of people were structuring stuff so they do not meet the $10,000 criteria or even the $1,000 criteria. If there's a structuring of payments and it could be traceable, then you still fall in the $10,000, and now it could be deemed money laundering. So that's why every single transaction that has a $10,000 or more of value must be reported, and anything that's from $1,000 and up must be reported. If you own a multi-service company, or if you've ever owned one where you have Western Union, MoneyGram, or anything like that, right? You'll know. I had one, so you'll know what it is to go through every other day getting called for compliance. Every other day was like, hey, did you notice that this person paid 500 here and then 500 there? Like, yeah, I did notice. That's the cost of the service. It's a service that they're paying, and they're paying $500 a week for it. Well, why didn't you report? It doesn't look like it's suspicious. It's a payment for a service. Well, do they know these people in this country? I'm like, well, I didn't ask. But if I felt that it was suspicious, I would report. Like, it's so much of a headache that I canceled. Like, I'm not dealing with Western Union or MoneyGrams or anything like that. It's just a headache, right? For me, it was. So everything for them was suspicious. That's what it was. Anyway, the other question here we have is the true cost of interest is shown on the LE or just on the CD? It's shown in both. So Nina, up front, you have to have an idea of those numbers. Up front, how much is it going to cost? That's why you have the LE. So yeah, shown everywhere. Questions? I got 4 people watching on YouTube. If you guys have questions regarding everything we went through, drop them now in the chat. I'll address it. Amy. Let me switch this to the chat. Okay. Amy, within those 30 years of that mortgage, if you happen to win some extra cash from the winning a scratch off, is there a penalty if you paid off mortgage completely? So in this example that we went over, it says the prepayment penalty exists only for the first 2 years. See? Prepayment penalty only in this particular example, only for the first 2 years. So if you pay after the 2 years, let's say you win the scratch off, right? And it's enough money, or Mega Millions or Powerball, whatever. There's enough money to cover the mortgage and pay it off, right? If it's within the first 2 years, in this example, if it's within the first 2 years, you can pay it off, but you're going to pay another $3,240. Okay? And this is because it's a conventional loan. If it was an FHA or a VA, no prepayment penalty. And then conventional loans could also have a no prepayment penalty, usually depending on which state they're in. Like state of New Jersey, no prepayment penalty on any type of loan. Okay? Other states, maybe as high as $3,240 for the first 2 years, or for the first 5 years, or whatever they stipulate. So to answer your question, Amy, yeah, you might be able to pay and not have any penalties, or you might have some penalties. It will tell you right here. Felix is afraid. What's going on, man? Let's go to Felix chat. Bruno, I really want to know about those $10,000 because I've been doing these transactions, man, and want to know what the IRS is doing. So, what do they do with that information? They start analyzing your tax returns, and if your tax returns or any other reporting from bank accounts, whatever, because it all goes into one system. If any of those do not substantiate having $10,000 available, right, or where did it come from, then they can open up an audit. Because if it's money laundering, where did the money come from? If you make $12,000 a year and you have $10,000 transaction that year, how did you make that money? So they're going to see the previous year. Did you make $180,000? Did you make $30,000? Is it possible that you have this money? Right? So they're going to look for red flags. That's what it is. So the CTR and the SAR are pretty much to report red flags. Okay? And by the way, if you have money in another country that falls within this group of countries that agree to it, so there's 40 countries that agree to this union. If you're in one of those countries, and expanding, I'm sorry. If you're one of those countries and you have $10,000 or more in assets, whether it's cash or properties in another country, technically you have to report to the IRS here if you're doing taxes here, and vice versa. Okay, just letting you know. All right, so if you don't report such transactions, is there a way they could find out? So if you haven't ever been audited by the IRS, then you would not know what happens. But when you get audited by the IRS, it's pretty much the same thing as this. They're going to have here, in 1941, you were born. In 1957, you spent $405 on this. In 1981, you opened a checking account and you put $1,000 there. So they have all the details about you. They know everything. IRS knows. Deceiving the IRS, tax evasion, is a huge crime. Okay? So, and I could talk about IRS and the fact that technically we don't have to pay anything, but because of the way they have instituted their rules and regulations, not laws, but rules and regulations, if you don't, then they come after you. So anyway, it's how you report yourself. So they will have everything, like, hey, you had a credit card, you had a mortgage, you had, like, everything's detailed, the whole history is there. So is there a way they can find out that a transaction occurred if you don't report? There might be. Like 99% of the stuff is going to show up on their end, yes. Right? Is there some stuff that could be hidden? Possibly. Right? Am I going to tell you how to do it? No. But yeah, everything you have is reported to the IRS, and how you do your taxes is key. All right, so Elda, she can help you out with that information, right? CPA. So she can help you out with that information. How you do your taxes is key. Can you report the $10,000 transaction and still not have to pay anything? How you do your taxes is key. Okay, a lot of people don't report stuff because of tax purposes, paying taxes. But again, key. Okay? Nina, how do you find out which countries are in the agreement? Hold on. Okay. This is international. And here it shows they reviewed over 100 countries as of February, part of it. These are the dangerous countries. They will have a list here. Sorry, countries right here. All right, and they tell you which countries are part of it. So we are part of the FATF. These are the member countries right here. There, right there, right there. Look, United States. Boom. Okay. So these are all the countries, and they are part of the FATF. There are other agreements around the world of sharing information, but FATF is the most common one and the one that links all these countries. Okay. So again, right here, all these countries. Look, Portugal. We're there. I cannot hide, fortunately. Boom. All right, good. Any other questions? No? All right, cool. So with that being said, guys, we're done for today, and I mean for the morning. I'll be back at 5:30 with tonight's chapters 28, 29, and 30. So short chapter, the first one, and then two more. And tomorrow we have math. So if you guys want to do the math chapter at night, 5:30. All right, guys. So if not, then I'll see you tomorrow at 10 a.m. Thank you and have a blessed day.